After 15 years in FX markets, this is something I've noticed. Most clients I meet think that FX is a complicated, dense, technical problem. And in reality, that comes from the industry by design. Because if you understand exactly how markets work, you realize that most of what you're being told is completely unnecessary. Today, I'm going to explain FX market structure in plain English. No jargon or complicated chat, just what matters. And so by the end of this video, you'll understand more than most FX providers will ever tell you. Let's start at the top. When you hear the term FX market, what's actually being referenced is the interbank market. And this is where the world's biggest banks trade with each other. It's decentralized or over the counter, not like stocks and shares, which are what's called exchange traded. FX is an OTC product. It's basically a network of banks trading electronically and through systems that are connected 24 hours a day. If you see a rate on Bloomberg or Reuters or XE or anything like that, that's just the interbank rate, which is the price at which big institutions trade at in much larger sizes than you're likely to face. And this is important because you can't access that rate. Neither can I. All it gives us is a benchmark, which is essentially a rate that big institutions are trading with each other. Everything you're quoted or you achieve is the interbank rate plus a spread, which is also looked at as a profit margin. And that spread is where providers make money. So what is a spread? Simple. It's the difference between where the market trades and where you trade. As an example, if the interbank sterling dollar rate is trading at 125 and your bank quotes you 122.50, their spread is 250 pips. And that's their margin. Now, spreads aren't evil. Providers have to make their money. The question is how much and what you're getting in return in the way of value. Banks very often charge 300 or 400 pips on a trade. Apps might charge 20 or 30, but equally they offer no strategy. Brokers offer something somewhere in between. But here's what most people miss. The spread isn't fixed, it's negotiable, but it depends on the volume, the relationship, and how much pressure you apply. But there's also a trap. Focusing purely on spread means that you miss out on more important things like timing, structure, and strategy. And getting those wrong will cost you far more than a difference in spread. I've seen lots of businesses save 20 pips on a spread, but lose 500 pips through poor execution. Spread was great, but the outcome was terrible. Let's also look at liquidity, because this matters more than most people realize. Liquidity is how easy it is to trade a large size without moving the market. High liquidity means tight spreads and fast execution in any asset class. Low liquidity means wider spreads and slippage. The FX market is most liquid through the London and New York trading hours, essentially 7 a.m. UK to 10 p.m. UK. That's when big institutions are most active. In fact, 70% of the world's FX goes through London. If you execute outside these hours, which you can do from Sunday night through to Friday night, then essentially you're trading at lower liquidity. The spread could be wider, and sometimes the execution might be slower. This is why I always ask, when do you need to transact? When do you need the currency buy? Because if you have flexibility around timing, then we can utilize these different markets and try and make gains more than a few pips on a spread ever will. Liquidity also changes around big news events, like central bank announcements for employment or economic data. And again, these situations could be used to your advantage, but only if you've got structure. Without structure, it's just gambling. And brokers often push clients ahead of news events, using it as leverage to get them to book a trade. Not because it's smart, but because it generates volume. And here's a quick point on currency pairs, because this often confuses people. Major pairs are the most liquid. Sterling dollar, euro dollar, dollar Japanese. These are far more liquid than a pair that contains two exotic currencies, for example. Cross pairs are anything that doesn't contain US dollars. For example, sterling euro, euro Japanese yen, Australian dollar, Canadian dollar. These often have much wider spreads because they're not so highly traded. If you're trading a cross pair, it's important to remember that the dollar still has an effect on those trades, and often it's the dollar we look at for guidance around forecasting and trend analysis. This is all fine, it's just important to understand it. So just remember, not all currency pairs are equal. Liquidity drives the cost and the spread that you get on that transaction, depending on which currency you're buying and selling. And this is really important to factor in around the strategy. And here's the thing that most businesses get wrong. They think that FX is just about getting the best rate. So they call 3 brokers, a bank, and just take the lowest spread. Rates only matter in the context of timing, structure, and the requirement your business has. For example, if you're under-hedged and the market's moving against you, the best rate today is irrelevant compared to what you could have hedged a week ago. Conversely, if you're over-hedged and stuck in forward contracts, you've just got a different problem on your hands. So the question isn't what is the best rate, the question is what's the right structure for my exposure and when should I execute? And that just requires understanding of the market, not trying to predict it, understanding it. Where's the trend? What's realistic? What's the business timeline? And what's your risk tolerance? Those questions matter far more than 10 or 20 pips on a spread. So this is what you actually need to know. You don't need to become an FX trader. You don't need to read every single economic report, and you don't need to predict where currency is going in a month's time. You just need to understand 4 things. Number 1, the interbank rate is a benchmark. Everything you're quoted is that rate plus a spread. Number 2, liquidity determines cost and execution quality. Timing really matters. Number 3, not all currency pairs are equal. Majors are cheaper and faster than exotics. Number 4, rate is a component of strategy, not the strategy itself. Focus on the outcome over the medium and long term, not just the transaction itself. If you understand these 4 points, you're ahead of 80% of businesses that trade internationally. In the next video, I'm going to walk through what happens when FX strategy goes wrong. Not theory, real business and real costs. Because understanding the market's one thing, but applying it correctly is another. If you're a business exposed internationally and you want to talk through anything specific, there's a link in the notes below where you can book a call. No pressure or sales, just use it as a sense check. And if this has been useful, please hit like, please subscribe, and thanks again for watching.